In 2024, while your neighbor's portfolio was hitting new highs, Warren Buffett sold off $173 billion in stock and did something almost nobody does with money that big: nothing. He didn't rotate it into the next hot sector. He didn't buy the dip. By early 2026, Berkshire Hathaway was sitting on $397.4 billion in cash and government bills, doing absolutely nothing except waiting. Either the greatest investor alive lost his edge at 95, or he knows something about money that most people never learn. Picture the last barbecue you went to where someone couldn't stop talking about the stock that's up 40% this year. Everyone at the table starts nodding. A few people quietly pull out their phones to buy in before they miss more. That itch in your chest, the one that says everyone's getting rich without me, has driven more bad financial decisions than every recession combined. Buffett doesn't have that itch, and that, not some secret prediction, is the whole story. Years ago, Buffett borrowed a rule from the old hitter Ted Williams. Williams said the secret to hitting .400 wasn't swinging at everything that came near the plate. He broke the strike zone into dozens of tiny boxes and only swung when the pitch landed in the one spot he crushed. Every other pitch, even a decent one, he let go by. There's no penalty for taking a ball. The only penalty is swinging at a bad pitch. Buffett runs his money the exact same way. Nobody's forcing him to buy anything, ever. So when the pitch looks bad, he just doesn't swing. Stick with this, because it's where most people get the story wrong. By 2024, almost every pitch looked bad. Apple's actual business, the real one, was growing about 1.5% a year. Solid, unspectacular. Meanwhile, investors were paying north of 30 times earnings to own the stock, betting on a growth story the numbers weren't telling. So Buffett didn't dump Apple in a panic. He quietly walked it down from nearly half of Berkshire's entire stock portfolio to about a fifth. He did the same with Bank of America, selling steadily from mid-2024 into 2026, right as the bank sat on more than $100 billion in paper losses from bonds it bought back when interest rates were near zero. Neither move required Buffett to predict a recession. It only required him to look at the price tag and say, "Not at that number." Here's the part that should actually get your attention. This is the same guy who, on January 1st, 2026, handed the entire company to Greg Abel and stepped back to chairman. He didn't unload that $400 billion war chest on his way out as some farewell victory lap. He handed it to Abel along with the same rule: wait for your pitch. Abel has done exactly that ever since. Now compare that discipline to what everyone else was doing with their money in the same stretch. The biggest tech companies poured over $200 billion into AI data centers and chips in a single year, racing each other before anyone had proven the spending would pay off. OpenAI reportedly loses more than $1 for every dollar it earns. A lot of that spending is circular. One giant funds another, which buys chips from the first, which books it as revenue. From a distance, it looks like a boom. Up close, it's money changing pockets inside the same room. That's not proof a crash is coming. Nobody can prove that, and anyone claiming they can is selling you something. What it is proof of is exactly the trap Buffett refuses to walk into, paying full price today for a story that hasn't happened yet. So this isn't a video telling you to panic. It's a question. For 2 straight years, Buffett watched other people get rich faster than him and didn't flinch. Most people can't sit still like that for 2 weeks, let alone 2 years. Could you?